Thank you for tuning in, everyone, and welcome to our newest webinar on passive investing into the short-term rental real estate market. This episode is going to be co-hosted again by Adventure Capital, Rogers Capital, and TechVestor. And today we're going to be talking mostly about the Airbnb market, right? Is it a bust market or boom market? We'll kind of break this question down further. I'm really stoked to be joined, though, by Seif Kafagi and Danny Rogers today. I'll let them introduce themselves in a minute, but first, going to do a quick preview on some of the awesome content we have. If you're in the crowd right now, it's possible you're a current investor. I see at least one or two. You might be a potential investor. Maybe you're just here to learn, right? However you found us, I think you're going to have some pretty interesting insights today. If you've joined on previous webinars, which I see a few familiar names, some of this content will be similar, but I think a lot of it you'll find will be more focused and rotating around the market, what's going on in the market, specifically in STRs. So we'll kind of kick off with a little bit about us, our team, our operations. We'll talk about our track record and performance, because I think it lends itself to why we have the perspective we do on this market. And then we'll get into the meat of it, right? What's the market look like? What are people saying? Is it a boom or bust market? What are the main drivers that are leading us to these conclusions? And then we'll shift back to kind of our approach on solving these, right? How do we solve these problems? What's the competition? How do we protect investor capital? What are the numbers, perks, and more? If you're interested, we'll tell you how to get involved. And then we're going to aim to probably have like 10, 15 minutes or so of Q&A at the end. So we've carved up 45 total. Please do write down your questions, and we'll make sure to get to some of those at the latter half of the call. Sweet. So my name is Stephen Gary. I'm the founder and principal here at Adventure Capital. We've been syndicating and investing in multifam for about, and short term, I should say, for about 5 years. Same with Danny over here at his firm, Rogers Capital. Danny and I currently run a joint fund, and we're partnered with Seif Kafagi over at TechVestor. So again, we'll let Seif give a background in a minute, but really Danny and my backgrounds are pretty similar in that we come from the sales world into real estate. I was a former global VP of sales at a public cybersecurity firm, and held numerous VP of sales roles in the tech world across mobile app development, security operations, you name it. So I've found myself in a position that I think a number of you probably can relate to, which is being a high earner or having access to some capital, but having no time to actually go and actively manage real estate, or really kind of expand that project portfolio. So Danny comes from a similar world. I think we both shared that experience and really found syndications to be the answer to that. We partnered with TechVestor, I guess coming up on 3 years ago now, Seif. And our relationship predates that. We've worked with some of the co-GPs on the TechVestor team for probably upwards of 5 years. It's really remarkable what Seif and the team have built. So I'm going to let him speak to that, but I'll let Danny, if you want to just quickly say hello, then we'll hand it over to Seif.
Yeah, thanks, Stephen. And appreciate everybody making the time this evening. We know evenings are valuable for all of us. So hopefully we can give you a few nuggets that you leave with. But yeah, Stephen, you hit the nail on the head. We both come from sales background. I'm currently in the medical device space, but have been in active real estate over the last, 5 or 6 years. And, it's the exact problem that I'm sure many of you have is you have the income or you have the cash to put to work, and it's hard to do that and execute on a high level. I'm currently in the process of offloading a few duplexes right now and some other larger projects. But we're really excited to have you all here, and I'll hand it over to Seif for his intro.
Yeah, thanks, Danny. Thanks, Stephen. And yeah, going on 3 years feels like it was yesterday. Actually see one of our real estate agents in the crowd today that we've worked with in the past. Hello, Bill. And so small world it is. Background of 5 years in tech. I spent building teams at Facebook. Sabrina, who's my co-founder, she was at Apple building AirPods, and we wanted similar things to a lot of people on this call, and actually some of the things that Stephen and Danny hit on, which was how do we break away from our W-2 and build financial freedom and get some cash flow coming in the bank, and give us options. For me, my primary motivation has always been I'm a young dad, so I have 2 toddlers, and Airbnb, and I'll touch on it a little bit, I see differently through the lens of a parent than before, and you'll see that reflected in the types of homes we build and develop and renovate. And I think generally speaking, we've now done this 100 and almost 140, 150 times across the country. So it's been a wild journey. We've been able to operate quite well, in my opinion, and really understand what makes a good short-term rental and what doesn't. At this point, I like to say at the beginning of the days, we were going off of thesis and theory and hypothesis and third-party data. And while we still use those today, we certainly go off of internal data a lot more right now that we have significantly more data points as to what works and what doesn't and what works better. So we're excited to share that journey with you today and see if it's a journey that you'd like to take with us.
Yeah, thank you, Steve. And maybe you could give a little bit of perspective into this talent stacked bench you guys have at TechFest, or maybe some of the key players.
Yeah, coming from a people and recruiting background when I was at Facebook, I think something that I noticed very early on was the importance of people in building whatever you're doing. And especially in our case where, we were trying to do something that hasn't really been done before. And so what you're looking for are people who can solve problems without necessarily having a roadmap or a manual on how to get there. And so some of the people you see on screen include Josh, who's, one of our partners on the renovation and construction side, and, has been in the real estate space and construction world for a long time, including at places like DR Horton and Dreamfinder Homes. Mick Stonier was the ran portfolios at Vacasa prior to coming to us and working with us. Austin is our head of revenue. In my opinion, I think he's one of the golden childs of the STR industry. And while he may look like he's 25, the kid is a wizard when it comes to pricing. John is the, known as the Airbnb data guy in the industry. He is one of the leading experts on data visualization as well as data mining when it comes to short-term rentals. Taylor Jones, our head of acquisitions. If any of you are on Twitter, feel free to give him a follow. He's always a fun tweeter in terms of sharing what we're up to. But generally, our team, also has what I like to call white hair. And apologies for anyone who has white hair on the call today. But we were a young team when we started. Right. So we certainly reached out and got a lot of help on our bench, including people like Scott Shatford from AirDNA. He founded AirDNA. It's one of the largest short-term rental data and analytics firms in the space. Jamie Lane, who's their chief data officer, chief economist officer over there as well as several others. So both advisors and people, you'll find that we certainly have the right partners in the space to make the right decisions.
Yeah. Awesome. Danny, let's shift over and let's talk a little bit about how we operate. What does this investment look like typically?
Yeah, absolutely. So I think, big picture here, what we're doing is we're building a fund of properties for an investor that can get started with as little as $25,000. And unlike, active real estate, for an investor, this is a truly passive opportunity. We have an entire team of vertically integrated staff that Steve's going to dive into later, but I believe Steve, this is our 9th quarter of cash flow distributions that we're processing right now, right?
Yeah, it's coming up. We'll have probably close to 1.2 or 1.3 million going out to investors here in the next 10 days or so.
That's fantastic. I know my investors are all excited for that. And I think one of the things that we've done really well is, you've conservatively underwritten the portfolio. So there's some really strong equity upside. Investors keep 100% of the tax benefits related to their investment. And we'll dive into that a little bit deeper, but it's roughly 20 to 40% of the investment made. There's zero liability from a loans and lending standpoint, and that isn't only from an investor relating to the properties, but that's also each individual property relating to itself. So there's no collateral between properties. And of course, as an investor, you're also getting instant diversification across, 14 plus markets and 140 properties in the portfolio. So we've learned some things as we built out these two funds.
Yeah, definitely.
So I was just going to say this next, the next two slides, I'm going to have Stephen go back and forth between the two, but these are actually the exact same properties. So this is the before and after from the same, picture shot. And you can see that it's a complete turnover. So Steve, do you want to dive into, what are your favorite pieces about this property? What do you think has allowed it to perform well?
Yeah, I mean, I think something we look for in today's world is we make deals happen, not necessarily just buy them happening, right? And I think one thing that was a great win on this property is something that your average novice real estate investor doesn't look at is, for example, like where's the lot lines, right? And so you can see that clearly in the top left photo. We were able to basically rebuild that entire backyard with amenities because the lot line was in the back. And these are some of the nuances we're able to identify, right? Full basketball, pickleball court, outdoor bowling, fire pit, playground area, mini golf, pool area, all those types of things. We even study nuances as little as, what does better in revenue? Is it kind of these open air pools or these caged pools in this Florida market, right? The prior photo or before photo had a cage on it, and as you can see here, it doesn't. So we kind of tore all that out. We even study what kind of shape mini golf, right, tends to correlate to higher revenue as an example. So this was a unique one in that we not only built this entirely pet-friendly and kid-friendly home in the back, but we also took it from a 4-bed to a 5-bed, adding instant equity as well, right? Those double bunk bed slides, converting that, adding real estate value. Naturally, anytime we make a decision when it comes to renovation, design, amenities, we typically have what we call an 8-year North Star, right? In terms of our perspective, we ask ourselves, if we were to hold this asset for the next 8 years, what are we doing to it today so we can continue to stay relevant and profitable, both from a cash flow perspective, but also add equity to our bottom line.
Yeah.
And as we transition into this slide, Steve, talk us through the model and also, the potential exits that we're looking at from a fund level.
Yeah, I think for us, what I like to compare this to is if anyone here has gone to Costco recently, right? You walk in and there's this, big 6-pack of muffins. And they're giving you a deal on that because everything's generally packaged and you pay your membership fees. Essentially, what we're doing is we're packaging a portfolio of properties and we're essentially going to an institution, or institutions and offering to sell them this pre-packaged portfolio of high-performing short-term rentals. Now, what we're doing hasn't really been done before, right? And I think that's ironically the risk really in what we're doing is there is no direct comp. Now, the good news here is in talking to institutions, both big and small, they've all generally said the same thing, that this is something that's very interesting to them. They have a thesis on this asset class, and that they really have one of two options of breaking into this asset class. The first option is they can either buy a portfolio, which they haven't had the opportunity to do before because it hasn't existed, or two, they can build this portfolio, which they don't want to do because it's too slow to do so, right? Unlike other asset classes, you can't just buy 30 homes on the same street, prop them up and design them. It's unfortunately not how short-term rentals work at scale. It's a very hard asset to scale. And so what we do is what we call brick by brick, right? Unique designs, unique approaches, very, very slow burn. And if I'm an institution looking to spend or deploy 50 or 100 or 250 million in one full swoop, I've never had an opportunity to buy an existing portfolio of short-term rentals until today. Right. And so that's what we're positioning ourselves into, is being that premier option for that acquisition. Now, that's option A. If for whatever reason we can't exit in that motion, and as I mentioned earlier, it really hasn't been proven before, right? So that's kind of a little bit of the risk there. We can sell off each market, right? Think of selling things off to like regional buyers, and that's why we look at things like density, where we have 2, 3, 4 dozen homes in pockets. That's an option. Option 3, we can also sell off individual homes as high performing short-term rentals. In fact, we've seen a high demand from that specifically for people looking for things like tax benefits, vacation homes for themselves or second homes. And honestly, number 4 is selling these single family homes back to the market as single family homes, right? Over a longer period of time. So, in addition to all that, because we're extensively renovating and adding value on the front end, we're adding some great equity that compounds over a period of time with fixed rate debt, nothing that's forcing us to sell in the meantime, and giving us really flexibility. And I think naturally, one thing you'll find if you do become an investor with us is we value flexibility quite a bit. And we think that's one of the most powerful things of this asset class and how we've structured it. We have a lot of options to not only make money, but more importantly, to protect yours.
We'll unpack quite a bit of that, both from existing exits and protection of downside risk. Let's talk about this, Danny.
Yeah, so Steve, you mentioned it, but we're finalizing distributions this week, and for Q1 of 2024, I'll let you share the big news and the milestones that we're passing.
Yeah, I mean, this will be our largest distribution quarter to date in Q1 across both of our funds, which will put us right over $4.5 million. I think we'll probably be closer to that 4.7, 4.8 number as we continue to finalize. And we're approaching that coveted $5 million in cash flow in just a few short years. We're continuing to improve and grow quarter over quarter, drive down our expenses, drive up that yield, and continuing to stabilize here as we exceeded Fund 2.
Yeah, Should be
And
good
it-
news for the LPs I see on the call.
Yes, yes.
totally.
Soon.
And if we transition into this slide, I mean, I think there's a couple things to highlight. Like we mentioned, there's already 140 properties in the fund. We've tested the model on 8 different exits, and Sif, I'll have you touch on that in a minute regarding cap rates. But the fund is performing at roughly a target of 17% AAR. We have 60 properties in Fund 2. Fund 1 did close out at roughly 37 million. We have 8,000 reviews from guests, investors, and different partners. And we're in 9+ markets. Sif, walk us through kind of the cap rate exits. Where did we underwrite at, and where have the 8 exits occurred at?
Yeah, I mean, generally we're underwriting at an exit like roughly around that 7.5 cap. And our ones in the past have been roughly at 5.5 to 6.5. I do think that those cap rates are likely in the future if rates do come down. I think these were at times when rates were a little bit lower. So I don't think if we were to sell that today, we get those prices today or those exit caps. But again, we're not looking to stabilize and sell today, right? We're looking to sell and hold in the future a bit. I think some of the things that stand off on this screen, which really just lends a little bit more to operational efficiency, is I think we're over 8,000 reviews across our profiles on places like Airbnb, Verbo, from investors in general. And a lot of those reviews are what every single one of those reviews is a data point, right? That allows us to actually get better at what we do, right? Provide better experiences, build better ones. And what we're seeing in our second fund, which is the fund that's open for investment today, is we're hitting more home runs than we hit in the first fund. So anyone who's listening who's in Fund 1, that's not to say that Fund 1 isn't doing fine. It's just saying that we've gotten better, right? As you would expect us to here over time and time again. And then on that 17% target AAR, we don't factor in a refinance in our underwriting. So naturally, while we're focused on cash flow, we're expecting that the equity growth and the value of the net operating income and cash flow that we're generating in these short-term rentals is actually going to further inflate and grow our equity positioning because it makes more money than the home next door, right? I think we can all agree that if you're looking at 2 homes side by side, one makes 100 grand, one makes 40, you're going to pay a small premium or a large premium for the one that's making roughly 2.5 times more money, right?
And on that note, see if there's a question in the chat. I mostly want to save questions for the end, but I think this one's hyper relevant. So how would you quantify investor ROI? I guess this would be delineated between Fund 1 and 2. Fund 2 is obviously stabilizing still. So
I mean, I think when you look at like Fund 1, or really your first year, and I can talk about Fund 1 year 1, we underwrote that I think roughly at about a 5% cash on cash because it's our first year. We're finding properties, identifying them, stabilizing, et cetera. I think we were right above that, so we exceeded that. I think Fund 1 continues to push closer to that 7-8%, closer to a full year 2, which is generally where we expect to be, roughly in that range. And then really by year 3 to 5, we're expecting to be in that 8, 9s, 10s, et cetera, if not closer to 12 as we continue to stabilize. Fund 2 is coming out of the gate a lot stronger for a multitude of reasons, right? Better properties out the gate. We have more first party data. Our team has gotten better. Economies of scale that Fund 1 had to build up to, that Fund 2 gets to begin with, right? All of those types of things are, I think, reasons Fund 2 will probably exceed projections compared to Fund 1 in relativity. So that's how I would think about ROIs. Like your first year is going to be really, really hard to understand like what a stabilized ROI is because we continue to buy, identify, and launch. As it stabilizes, we should be in that 8 to 12% cash on cash range is kind of the initial target.
And we'll also walk through a specific model. Looking at $100,000 investment as an example towards the end of the deck tonight.
yeah, certainly. So I want to shift over and talk a little bit about the market. I think that's the main focus, and I realize, per usual, we're dragging along on time. So, Sif, let's give a little bit of perspective into what's being said out there in the wild. I want to unpack the boom or bust case, right? I think there's seemingly 2 sides to this story. And in the interest of full transparency, there certainly are people out there who are skeptical. Some of you on the call may be that person of the Airbnb market, right? Is it getting too saturated? Is it no longer the place to be? So maybe quickly hit on the bear case, and then we can shift into what's going right.
Yeah, I mean, I definitely think there's an influx of Airbnbs and short-term rentals onto the marketplace. The data suggests that quite strongly. Especially over the last 2 years, you've seen an increase in supply exceed demand. Now, I think that is the headline that I think everyone wants you to read. I think people want us to believe that short-term rentals are taking away from the housing economy. And that is the sole reason why people don't have affordable housing and those types of things. And, my response to both of those things is if you actually look at the data, the supply coming onto the market is actually not ideal, right? So in every market, there's what is known as ideal supply, meaning what does the demand want versus what is the supply that's being provided. And so because we look at that thing from a pure investment perspective, right, we're buying product in markets that are actually in demand. Your most common property on Airbnb are actually some of your smaller units, your 1s, your 2, your 3 bedrooms. We focus on 4, 5, and 6 bedroom homes, right? In large markets with high amenities, kid-friendly, pet-friendly, right? And, highly amenitized, well-designed, and professionally managed. Now, the things that I just mentioned to you right there, which is not that long of a list, right? Has a pool, etc. If you look at a market like Scottsdale, we'll just take that as an example, has 34,000 listings of short-term rentals. At its face, it looks like a very saturated market. If you simply look at properties that are 5 bedroom, which is the most in-demand property in that market that has the lowest amount of supply, has a pool, is professionally managed, allows pets, and is listed on Airbnb and Vrbo at a minimum, meaning 2 platforms. Forget the design, forget the amenities. You're down to sub 200 properties, right, in that marketplace. Now add in a good operator, great design, great amenities, kid-friendly, well-designed for the space. And as you might imagine, that list gets even smaller, right? Of which in that market, we have a dominating amount of supply, right? Meaning we, in a sense, can kind of control that mini niche or that mini monopoly of that type of product in that market, which allows us really to benefit from guests coming back in larger groups and obviously a little bit of pricing power as well.
Yeah, certainly. And I think we hit on a lot of the demand then outpacing supply. Let's go into the boom case a little bit further, maybe, Steve. So why are you particularly bullish then on STRs right now? And why does this look a little bit different than in previous years?
Yeah, I mean, really, it's 3 reasons for me. Right now, I think there's so much fear and greed in the marketplace that people are waiting on the sidelines. And to me, that's ultimately, historically speaking, a time to actually be active relative to others. Number 2, I think because we've done this hundreds of times before, our data set that we're using, our inferences, our insights, and all those things is an unfair advantage relative to others, right? Anyone entering this space cannot compete with us without going through the mistakes and ups and downs that we went through. There is no shortcut, right? And because of that, we're always going to be ahead to some extent, and that is going to allow us to identify deals that other people aren't necessarily looking at. And third, with scale, every property becomes better or cheaper to operate. So the bigger we get, the better our portfolios continue to operate. Naturally, because of the economies of scale, we continue to unlock. That includes goods, labor, among a multitude of other things, right? And so when you have those things going for you that are unfair advantages compared to the, call it mom and pop market, it's very difficult to compare us to them or in any sense. And while we might buy similar properties, our advantages are quite literally different.
Yeah. And again, I think we're focusing more on the trends of the market in this webinar. So I wanted to hit on what does this look like in the past and why is this different than the 2008 market crisis?
Yeah, I think first and foremost, and just to remind everyone here on the 2008 crisis, I think it's like over 90% of people who kind of lost their shirt during that time had floating rate debt. And I think that's what, people who don't read the fine print actually understand. And they had floating rate debt that came due at an inopportune time. That's essentially what kind of drove down 2008. Something for us is all of our debt is fixed for a minimum of 10 years. Most of it is fixed for 30, right? So, just alone on that, no one's forcing us to sell anytime soon, right? We've hedged and controlled and no one's knocking on our door saying you got a balloon payment due tomorrow. Our DSCR, which stands for debt service coverage ratio, hovers between a 2.5 and a 3.5x. What that means is after expenses, our net income relative to our cost of debt is 2.5 to 3.5 times. Right. So from a profitability perspective, we generally are in a profitable position most, if not every single month. And of course, we have our seasonality and trends, right? And we look at things on an annualized basis. Not to mention here, we have a diversified portfolio across geographies, across seasons, and all those types of things that you typically don't get into an investment, whether it's in multifamily or a single family home, because that's typically situated in a single physical location, right? All of those things would give us advantages compared to 2008.
So, I mean, what it sounds like is this is a good time to get involved. And so, let's shift over to talking about how somebody can go and do that. I probably would spend some time breaking down how you could do this individually. Of course, that is an option still, but in the interest of time, I think we'll shift over to more of the fund approach. And if you've got questions on how you could go and buy your own Airbnb, we're happy to talk to you guys about that after. Danny, maybe you want to talk a little bit about our approach from a vertical integration perspective.
Yeah, I think this is one of the biggest things that separates TechVestor, and Fund 2 from the rest of the market. And see if you can touch on this best. When you and Sabrina, started the idea of TechVestor, vertical integration and the, operating company along with the property management, that wasn't the big picture, right?
No, actually, we wanted to be a tech product, and we wanted to scale capital, and we wanted to do all the sexy things. So this was not in the cards. But unfortunately, when we hired property management partners, their expectation of performance was not ours. And we were poised with a position of, have an increased chance of failure or build it ourselves. And at the time, it was the hardest decision we could probably go through and one of the most excruciating. But in retrospect and looking back, I don't think we could ever scale this large and this successfully without it. And today it's one of our biggest advantages, right? Being able to identify acquisitions in-house, right? Be able to drive renovation and design decisions in creative direction, data insights and tools that we build. We build a ton of internal tools where we can tell you a lot of data that you probably don't care about as an individual, right? I mentioned some of these earlier, like studying different sizes and shapes of mini putts, right? Understanding what shapes of pools and sizes of pools correlate to higher revenue. Understanding not only what is our average daily revenue, but what's our average daily cost, right? In terms of what properties actually have higher expense ratios and which ones have qualitatively harder challenges when it comes to operating versus not, right? And all those things dictate what we buy next, where we go next. And in a blind fund, the advantage is that it gives us flexibility, but you have to have a team behind you and an infrastructure that actually gives you insights to do that.
Totally. So looking at how we buy and where we buy, Stephen, if you go to the next slide, here's a highlight of the markets that we're in. See if what's on the horizon, what's coming for 2024.
Yeah, I think right now when you look at Fund 2, we're in Arizona, we're in Florida, we're in Virginia, we're in Pennsylvania, and generally speaking, I think we're going to probably stick to those 4 or 5 markets for the most part. It's very rare for us to enter brand new markets, and the primary reason for that is we look for a lot of strong signals, and we market map markets well before we enter them. I think there's a couple markets in Florida that we're eyeing right now, as well as a couple in North Carolina as potential new expansions over time. Even just the Clearwater Metro that we've entered in Florida over the last couple of years. I mean, it took us, I think, 6 or 7 months before we ever entered that market at the time. We collect a ton of data, study it very well, better understand how we can win in that market, and what kind of density we get. And when we enter a market, it's not 1 or 2 properties typically. It's how can we get to 4, 5, 6, 7 pretty quickly to start building density and economies of scale. And in our 3 largest markets today, we have dozens of properties. Our 4th largest, I believe, we're right around 10 or 12, right? And as you can see, like we have favorites, and there's a reason we have favorites, right? From a seasonality perspective, economies of scale, even things like labor, right? While many of us on this call are thinking about building a passive investment, we also have to think about how do we operate this for the next 4, 5, 6, 7 years? What does blue collar labor look like on the ground to fix something, right? As an example, and those are questions we ask ourselves. Is that labor getting better, worse, more expensive, cheaper? All those types of things are things we consider.
Yeah, that's great. And as we, Stephen's, we're going to get some time back here for us, but we look at where we buy. Talk about how we buy. I mean, think about the data aspect and what makes us different from an algorithm and data analysis standpoint.
Yeah, our software can analyze hundreds of thousands of properties a month, right? And 94% of the time, the data tells us the deal sucks. And this was roughly about a year ago. Today, even more deals suck than ever, right? Higher interest rates have changed that. Operating costs and expenses, different lending requirements that you have to abide by. And so really what we're looking for, and I use this story of, if I was having drinks with a friend at a bar and I really needed to do some quick math back a napkin, is can this property that I'm buying do at least 20% price to rent, right? That's generally a good example of what would be the beginning of a good deal. So if I'm buying a home for 500 grand, right, is after renovation, design, furnishing, reasonable budget to do that. Can this home drive at least $100,000 in top line revenue? The second thing I want to ask myself is, does this property have a likelihood of maintaining below a 40% expense ratio, right? And what I mean by that is operating expenses, right? So on that 100 grand, is it going to cost me more than $40,000 a year to operate it, right? And, between taxes, insurance, mortgage expenses, all those types of things, I'm thinking about from an expense ratio, right? Sorry, not including mortgage. That's not included in my analysis. All those types of things I'm asking essentially to drive the highest NOI of this asset, right? And so that being said, I also ask myself, how can I make this better? And in fund two, you'll see a lot of our properties we buy is like a 4-bedroom that we convert to a 5. And so we might be able to buy at a 4-bedroom price point, build or add or find a way to add that 5th bedroom for 10 to 20 grand versus buying that additional value for 70 or 80 grand, right? In terms of a price value, we're going to be able to get significantly better revenue between the 4 and a 5 in this market, right? Because we know that that's going to win, and see where that tends to take us.
And I think that's a perfect transition into, one, looking at how we are outperforming our projections. This is one of my favorite slides. So when we look at Fund 2, I just looked at the numbers for the last 15 months, and we're outperforming our revenue projections by 37%. And something I take a lot of pride in is I send our quarterly updates to investors so that they can see by property. And not every property is perfect. I mean, you'll be the first to say that. There's some that simply are underperforming. But when we look at the total funds performance, we're at 137% of revenue projections. And we have properties that I think we even talked about this last night that are delivering 8% cash on cash within a 3-month launch.
Yeah, I think our approach is essentially building what's very similar to an ETF, right? If anyone here has ever invested in SPY or VU or any of those common ETFs, we and no one else will ever be 100% perfect or accurate. Right? It's a very unrealistic goal. So can we have significantly more winners than we can have losers is the idea. And that's another value of building a diversified portfolio of short-term rentals rather than one. If we're right even 70% of the time, the statistical probability that we have an overwhelmingly successful fund is significant, right? If we're even closer to 80% or 90%, that's even better. 100% of our properties that we've ever bought are cash flow positive. That doesn't necessarily mean I would buy all of them again, right? There are some winners in there that are significant winners, and there are ones that are significant, underperformers relative to our expectations, right? That doesn't necessarily mean that they're losing money, but you learn from those expectations. And even sometimes when you have a red month that like you see on screen, that doesn't mean that the property is underperforming. It could simply mean that it's, in a low seasonality month. In fact, we're in one market where 4 months out of the year, you make about most of your cash flow, right? That's the type of market that it is. In another market, you might have a lot more blend and balance, right? In terms of across the year. And so because we're diversified, we can have a little bit of everything in here and kind of build a fairly custom approach to seasonality.
Yeah. I think this approach is, starkly different from the mom and pop approach. So again, you have that instant diversification versus betting entirely on one market. And I think that kind of lends itself to where we see the competition. I'm not going to spend much time on this because I want to talk about institutional competition. But most of our competitors really are do-it-yourself operators, right? They've got one, maybe a couple properties. And this might resonate with a few of you in the audience. Maybe you've got, your own Airbnb or again, a couple, but you just don't have the economies of scale in that scenario to operate, property management and revenue management, and you don't have the access to capital and technology in the same way that we do. So with our approach here, with our scale, we really tend to easily edge out these players. What I want to talk about though quickly, Seif, is on the professional manager layer, outside of the DIY operator, how do we stack up and who are we kind of competing against there?
Yeah, one of my contrarian takes in the space is that I don't think third-party property managers and owners are aligned, right? And I think it's because owners have emotional attachments to properties typically, and property managers have every reason to essentially juice every penny from your property, but they're typically held back by owners, right? Don't rent my property for less than $400 a night. Don't allow pets. Blah blah blah, right? So we are fundamentally different in that we are an owner operator. And simply because we're an owner operator, we unlock efficiencies that the market does not allow for, because of when you have a professional property manager and an owner, you have naturally budding expectations, and they don't necessarily align every day. Now for us, because we're the same, it's natural fluidity when you think about performance, and it shows in our numbers, right? Being able to drive almost 70% more revenue than our competition in some of these markets, and almost 56% more revenue than the largest property manager in the country. Now, the reason I call that out is that company being Vacasa, they have a slew of data, right? They have arguably one of the largest data sets of performance, first level property performance in the country, but they're not leveraging it primarily because they're not able to, because their owners don't allow them. In our case, because we're owner operator, we're able to kind of sail right through and make the right decisions that are logical and lack emotion.
Yeah, absolutely. I want to shift out of competition and talk a little bit more about protecting downside risk. So probably one of the most frequently asked questions I get are, what are the risks? How do you guys protect against, bad financing, et cetera? And I think we already covered a lot of this with DSCR, so I don't want to spend too much time here, but see if maybe talk through how our acquisition strategy and again, the the avoidance of sloppy financing puts us in a good spot there.
Yeah, I think when I think about how we hedge, it comes down to a couple of things. First of all, we buy well. We are actually typically buying a little bit below appraised value. That's the first thing, right? Secondly, we're typically adding extensive renovation that brings up the equity value in the real estate asset itself, whether it's kitchens, flooring, landscaping, amenities, things that matter, adding square footage, things that are driving up like pretty easily identifiable real estate value locally. That's adding equity, and we're doing all of those renovations in cash. The reason that's important here is we're adding equity without taking on additional debt, right? So our equity in the home as a ratio to our cost of debt or our amount of debt is actually pretty high. Like we're actually in a good, comfortable space. Separately, and touched on this earlier, all of our debt is fixed. There's no floating rates, and none of it is cross-collateralized. What I mean by that, and excuse me here for being a little bit direct, if I lose a finger, right, I'll probably survive. And that's the same analysis that we take to our approach here by building a portfolio. If everything is cross-collateralized, even if that might mean we might get a half point or a point better on rates, right, and something happens, the entire portfolio is at risk. If we have one underperforming property and we need to take a loss on that property and we need to sell it, we'll probably be okay, right? Hasn't happened. Don't think it'll happen anytime soon, knock on wood here, but that's kind of the idea of how we hedge.
Yep. All right, let's talk numbers and perks. So walk us through the actual kind of investment structure here, Danny.
Yeah, absolutely. So we already discussed it, but 25K minimum investment. We're looking at a 4 to 5 year hold. Initial target was 4 to 6. 100% of the tax benefits go to the LP. We're projecting about 20 to 40% via paper loss on a K1. Quarter distributions are paid out quarterly, and I think this is a big piece that differentiates us from historical real estate investments. Is about 50% of the return is captured through cash flow. So you're not waiting until the end of 5 years to get money back in your pocket. DD already asked this initially, but essentially looking at our cash on cash, year one's targeted at 5%, and year 5 we're getting all the way to 11 or 12% targets. And then as those investments stabilize, we have no asset under management fees and projected average annual return of between 17 and 20%. And if we go to the next slide here, Here's our waterfall structure. So we actually have a 9% preferred return with a 65-35 GP/LP split. So after the 9%, 65 cents of every dollar of profit are going to the LP. And this is just a base term. So those of you, some of you are actually on the call tonight who are looking at larger investments. We do have better terms that we can offer for a larger check size. And again, I think it's important to emphasize this is passive from day one. There's no active decision making involved.
Yep. Let's go through a mock model of this as well.
Yeah, and just to really highlight in the center of the page here, visualizing $100,000 investment, obviously $100,000 would go in year one, about 5,000 is being kicked out in cash flow. And we actually are, we are hitting that projection, but in both fund one and fund two, we're actually outperforming it. Year 2 and 3, as we start to stabilize, you'll see that return get closer to, between 8 and 10%. And then years 4 and 5, our projections, and we'll have a better idea of, how much, or, on the outperforming aspect as we move through the fund and we're stabilizing. But the good news is our revenues are significantly outperforming our underwriting. And then, Steve, do you just want to touch on the waterfall really quick? What's the value of partnering with like a Rogers Capital from a terms, Rogers or Adventure Capital from a terms standpoint?
Yeah, I mean, look, we partnered with Danny and Steven for many reasons, but one of them is, they fight for the best terms for their investors and everyone on this call. I think if you were to go to TechFester today and make the same investment, you'd be getting slightly, worse terms, to be quite frank. All right. And that's primarily because Danny and Steven come in and, they negotiate writing a larger check. Right. They say, hey, we're going to commit to bringing, TechFester $2, $3, $4, $5 million this year. And in doing so, they want better terms for their investors and their LPs. And that's something that you're able to benefit from. Right. So they've already gone out and kind of, done that battle for you as well.
And I'm answering questions for DD in the chat, but there are a number of tiers, and this depends on which fund you've invested into. But basically, at a higher investment amount, like Danny pointed out, there are advantages to that waterfall split. So you may be able to achieve 9 and 70 or 9 and 75. Right? We've got people entertaining check sizes of upwards of $2 million. So a wide range of scale there.
And as we transition to the next slide, DD, this actually answers another one of your questions. So we actually do handle some direct bookings. The majority of the business, Steve will be able to touch on this better, is going through a third-party booking. But for investors, existing customers, they can book directly with TechFester through our concierge service. Austin handles that. And you're essentially saving the 10 to 30% of service fees from Airbnb. And it doesn't affect the fund performance at all because the same net profit goes to the fund.
Yeah. Cool. I want to get to questions, so I'm gonna kind of skip the recap. I think we've hit on a lot here, but my, I guess, summary of this would be like there really is an Airbnb boom, I think, and a prime market opportunity that we're capturing on. So we've talked through all these elements to the left. If this is interesting to you guys, right, what I want to shift over to is what happens now, right? What are the next steps? And maybe you want to take some time to review this further. That's absolutely fine. Again, we'll distribute this recording and all of the information. Maybe this isn't for you. I'll also point out that's totally fine, right? If you still want to connect and talk to us and get our opinion, we probably have other, access to investments or friends in the industry that we can connect you with. So no hard feelings there. We want to be a resource, but if you're one of those in the crowd right now who's incredibly keen to get started and get involved here, let us know, or you can go click that, reserve a spot in the fund link I dropped in the chat. So go check the chat. We'll basically send you the paperwork. So there's a pretty industry standard PPM. You sign that, you wire the funds, we verify accreditation, and then we add you to our investor portal. And that's pretty much it, right? It's a fairly smooth process. You've got incredible amount of transparency in this portal. So I think the actual investors on the call could probably speak to this, but I mean, we're constantly providing updates into property performance, fund level performance, new opportunities to invest with us. All of your distributions are tracked through here, and we'll start distributing cash to your bank account in the first 3 to 6 months. So it really is a smooth process. Before we open it up to questions, I just want to say thank you to everyone who did take the time to join. I know we've lost about 10, but Steve, thank you for being a wonderful guest as always. You really are like the most dialed operator, and it's a pleasure to work with you. And this fund's been so fun. Both funds 1 and 2 have been really fun, but with the performance this strong, the fun keeps coming. Hopefully there was some good takeaways for everyone here on the market as well. And we hope you stick around. Like I said, I did throw the links in the chat. So if you're interested in looking into the data room, everything that we talked through today is going to be available in that data room, as well as some former webinars, podcasts, and other resources. So we'll start there. We'll make our calendar links available, and let's switch over to questions. So if you guys want to start raising hands, happy to do it that way. Feel free to jump in and just start talking. Didi, it looked like you kicked one off. So actually, let's go to Bill, and then we'll come back to your question, Didi.
What's up, everybody?
How are you, Bill?
Hey, Bill.
Yep, worked with Steve, worked with you in the past. I used to work as a vacation rental investor consultant at Evolve Vacation Rental, so pretty familiar with the industry. Kind of big question I've got is just also being in real estate right now as an agent in one of these markets. Just seeing a lot of the opportunities where the acquisition price of these assets has kind of neutralized some of the returns. So I've gone and invested in some kind of non-traditional, like basically built opportunities. So is that something you guys have any interest in, or is it just a little too weird? And what I built like a container house, so we've gotten all-in cost for it was like $417, and we're tracking to make like $93,000 in revenue with it. So just those kind of alternative asset types, because also looking to scale and try to make that happen, because a lot of the current inventory here is like shrug worthy at best when it comes to returns. So just curious as far as appetite you guys have for some of that stuff.
Yeah, I mean, I think it's a great question. We get a ton of great pipeline and partnerships with people who are building really what you're describing is like unique experiences, right? In terms of, container homes or glamping or tree houses, or among several other things that we can do. We haven't taken a stance yet today of building. Development has different levels of risk than renovating, not to mention the exit strategies are quite different for building unique experiences, right? I can't sell a treehouse as a single family home as a plan B or a plan C. There's different levels there. That doesn't mean that they're not great investments. In fact, 2 of my good friends literally do this for a living. All they do is build like 60-unit short-term rental niche type things, all across the country, and they do quite well. I think if we were to enter the development space, we'd probably co-GP that with an operator first, and where we would bring our operational chops where we excel, and probably not take on the development risk on our side. And that's kind of in the interim. I think it's certainly something we'd consider in the future, but we do think that building the unique experiences has a place. But I don't think the place is today with where rates are at. I think that there's risk in doing so, and the exits are a little less proven. Not to mention, I think the economics that you provided, while I agree may not exist in your market, there are better economics that already exist without having to build than the one that you provided, right? And so, for us, we're getting, while we aim for 20% price to rent, we're often getting 25, 30% price to rent ratios without having to take on the risks of building.
No, that's great. Thank you. Yeah.
Yep. Thanks, Bill. I'm going to come to Guillermo's question. So can you invest internationally? I think you somewhat answered your own question, Guillermo, but yes, you can through an LLC if that was stateside. I believe, and correct me if I'm wrong here, Steve, but we can also do that if you have an American EIN or tax ID. So if you're, depending on your visa situation, there are a couple avenues, but yes, we do work international.
And Didi, one other question at the top that said, do you pay for renovations with cash in addition to the 25% down? I think you mentioned that, Steve, but you can dive deeper into it.
Yep. So all of our renovations and design that we do is completely spent in cash. It is not financed at all. That is intentional. And while we could obviously lever that up and probably roll some of those costs in either with credit cards, partners, lending, or other types of loans, we don't think it's the best risk-adjusted strategy, right? So for us, it hurts us a little bit from a leverage perspective, but it does lower the overall risk of the portfolio in terms of the equity we have in the homes to a place that we feel comfortable and confident. And we're spending our money in the right places, right? Renovations, improvements, things that add equity, not necessarily deter from it.
Good questions. I know we're coming up on the hour here, so anything else from the crowd that we did not get to? Awesome. Well, I want to let everyone get a little time back here if you were planning on the hour. I'll flip up the disclaimer, but again, you've got everything in the chat. I'll copy and paste that all again, so it's really easy to access. I'd recommend going to that data room if you want to do some more poking around. We will package up the recording from today, and we'll send this in an email to everyone who joined. So if you had family or friends or other connections who might find that interesting who couldn't make it, certainly encourage you to send that out. But yeah, thanks so much for the time, everyone. Feel free to reach out to me or Danny or Steve, and we can get you going. And we will look forward to talking soon offline. Have a good rest of your evening.
Danny, Steven, thanks for having us.
Thank you, Steve. Thanks,
Yeah,
crowd.
thanks.
Everybody.
Everyone.